All right, today we're going to discuss real estate IRAs versus 1031 exchanges. Your presenters today are Kristen Bennett and Kelsey Deneen. If you do have any questions, please type them into the chat box, and at the end of the presentation, we will answer them all at once. All right, Kristen, take it away.
Okay, I'm actually going to start on this one. This is Kelsey Deneen from Midland IRA. I'm a CISP here. I'm certified to talk about our IRAs and also 1031 exchanges. So here at Midland, we're a very interesting financial company because we do not give any investment advice. What we do really is we act as either your qualified intermediary for a 1031 exchange, or we are the IRA administrator for a retirement account that allows you to do real estate investing. So we're never giving any tax, legal, or investment advice. We're here really just to tell you what the IRS regulations are and assist you with those. That way you can use your retirement funds and conduct 1031 exchanges to take advantage of those tax benefits. As an IRA administrator, we have over $1 billion in client assets. Again, we don't sell anything, so we're not making any commission. Keep in mind today, all this information that we cover is really just for your educational purposes and to further your knowledge of these two tax tools. So if you do have any very specific questions in regards to legal or tax purposes, just please be sure to consult your attorney or your CPA, as they can give you specialized advice to your particular situation. Again, today we're going to be talking about these two tax strategies and how they can benefit you as a real estate investor. Okay, so the choice is yours. We do not, again, give any investment advice. This information is for educational purposes only. And if you do have any specific questions about the content, please type them into the chat box, or feel free to follow up with Kristen or I at the end of this presentation. We'd be happy to talk to you about your exact question and how you can use these tax strategies to defer paying the taxes in a 1031, or be able to diversify your retirement funds into things such as real estate.
Okay, my name is Kristen Bennett. I'm a senior associate here at Midland. I work in our client services department, so I work with clients who are directly using their IRA funds to be purchasing real estate. So we're going to briefly go over purchasing real estate in your IRA and those benefits. So real estate is a very popular investment with self-directed IRAs recently. A lot of people did not realize that they can use their IRA funds to purchase assets like this, and it's something that we specialize in. The benefit to purchasing real estate in your IRA is that you can control that investment. And because these are cash deals, the turnaround time is very quick in terms of getting the closing paperwork done and getting the closing complete and having that property titled into your IRA. One of the great things about that is once you hold that property in your IRA, all of the gains from that property are tax sheltered. So that means any rental income as well as any gains from the sale proceeds, they'll come straight back to your IRA and they'll stay in that tax deferred status. And if you have a Roth IRA, you might never get taxed on those gains. So what are the different types of properties that you can hold in your IRA? You're not limited to just a single family home. A lot of people don't realize that you can purchase multifamily homes, which means apartment buildings, townhouses, condominiums. Other people hold commercial property and rent out that property to other small businesses. You're also able to purchase vacant land, improved or unimproved land, trust deeds, and tenant in common interests. So,
Kristen, we're going to start from the top. We had a few technical difficulties, so I'm going to start from the beginning, if you don't mind. All right, thank you all for joining us for today's webinar on real estate IRAs versus 1031 exchanges. Your presenters today are Kristen Bennett and Kelsey Deneen. If you have any questions, please type them into the chat box and we will answer them all at the end of the presentation. To get started, Kelsey is going to begin.
Yes, thanks so much for tuning in, guys. Sorry about the late start. We had a technical issue at the very beginning, but now everything is running smoothly and hopefully everyone can hear us. So Midland IRA is a self-directed IRA administrator, and we also serve as a qualified intermediary for 1031 exchanges. Now, what this means for real estate investors is we offer you two very valuable tax tools. The first one being self-directed IRAs. So for investors who have retirement funds and they're looking to diversify maybe out of stocks and bonds into real estate, this is a way to actually use those retirement funds and place them in real estate as an investment within your IRA. So these are investments that are tax sheltered, similar to how people will buy stocks or bonds. All income from the real estate investment returns to your retirement account. The other tool we offer are 1031 exchanges, and we'll be talking about those today just to compare the two tools. So 1031 exchanges are a way for an investor to sell an investment property and roll the sale proceeds into another investment property without paying the tax bill. Your taxes that you'd usually pay, like capital gains, depreciation, or capture tax, those are essentially deferred. So that leaves more money in your pocket for you to reinvest in your next property and gives you more purchasing power. So those are the two tools we offer. And again, keep in mind during this webinar, we are not giving you tax or legal advice. We are here as the IRS experts knowing those regulations and coaching you through what rules you have to follow. None of this should be taken as legal, tax, or investment advice. We do not sell any investments. We do not make any commissions. And that's why we can offer things like real estate within the retirement accounts that we hold. So again, feel free to ask any questions at the end of this webinar, and we would be happy to address your particular scenario. So again, the choice is yours, and I believe Kristen now is going to take it in regards to real estate IRAs and the various benefits they offer retirement fund investors.
I'm Kristen Bennett, and I'm a senior associate here at Midland. I work on our client services team, and I assist any of our clients in purchasing real estate to hold in their IRAs. So I'm going to briefly go over why people purchase those types of assets and how to go about it. So real estate has recently become a very popular investment in self-directed IRAs. There are a lot of funds out there, retirement funds, that aren't currently being used in real estate. Only 2% is actually currently invested with that specific asset. And people just don't know that they're able to use those funds to hold this type of asset. One of the great things about purchasing real estate is it's an investment that you can control. When you're purchasing this with your IRA, it is considered a cash deal, so the turnaround time is very quick in terms of getting the paperwork ready and completing the closing. Once the closing is complete, the property is now held in your IRA. So now that you have that title, all of the gains from holding that property are tax sheltered. So that means any rental income as well as any gains on any sale proceeds when you do finally sell that property. The funds come back to your IRA and stay in that tax deferred status. If you happen to have a Roth IRA, you might never get taxed on those gains. So a lot of people don't realize that you're not limited in terms of what type of real estate you can hold in your IRA. You can hold single-family homes, multi-unit homes, townhouses, apartment buildings, condominiums. It doesn't necessarily have to be a private residential. It can be commercial property so that you can rent it out to a business. You can also purchase vacant land, whether it's improved or unimproved, as well as trust deeds and tenant in common interests. So the important things to consider when you are looking to pursue this route in your IRA is that the title for the property has to be very specific. You'll see our vesting is Midland IRA Inc., FBO, and it would be the client name and the client account number. And this would have to be on all of the documents for purchasing that property. The percentage of ownership held would depend on whether or not you are solely purchasing it with your IRA or it's just a percent owner. one thing to consider is that when you hold this property, it is for investment purposes only. That means you are to have no personal use of the property while it's held in your IRA. Any income and expenses related to the property have to flow through the IRA. So that means any rental income would have to come back here, as well as any expenses for bill payments or utilities or things like that have to be paid from the IRA. And another thing to consider is that there are prohibited parties when it comes to doing these types of transactions. So a prohibited party is someone that's considered disqualified from your IRA. So that means you can't buy, sell, lease, or exchange with these parties. So that includes any lineal ascendants, so that would be grandparents and parents, a spouse, or any lineal descendants. So that's children, grandchildren, and their spouses. Another important party that you're not able to buy, sell, lease, or exchange with is you yourself. You as an individual are disqualified from your IRA. So there are different ways to purchase real estate. Like we said, this would be considered a cash purchase when you're purchasing it 100% with your IRA funds, and that means that your IRA would be the sole owner of that property. Another way is to partner funds. Now I know on the previous slide we went over disqualified parties, but you are able to partner with one of those parties on a new purchase. So that means that you are not buy, sell, lease, or exchanging between them. It's going to be on a brand new purchase. You can partner to purchase a property with those parties. In addition, if you don't happen to have all of that cash available in your account, you are able to get a loan, but it specifically has to be non-recourse. So that means that there is no personal guarantee, and the only collateral backing this loan is the property itself. Because of that requirement, these loans are a lot harder to come by. There is a larger down payment required, and again, you do have to qualify for the financing because there's no personal guarantee. So how do you start investing? The first step would be to fill out an application. If you were to go to our website, you can fill out our online application, which is brand new, or you can print the application and send it in. Once the account's set up, you will get a account number assigned to you, as well as a dedicated representative who would reach out to you about funding your IRA. And so you can fund the IRA either with a contribution. There are annual contribution limits to consider depending on the type of IRA, as well as you can either transfer or roll over funds from another IRA or qualified plan. Once the account's funded, then you can find the property of your dreams, and we would help you complete that investment.
All right, so now we're going to move on to 1031 exchanges, and this is Kelsey Deneen. So very important to note, these are two completely separate tax tools. So what Kristen just covered was using your retirement funds to purchase real estate within your retirement account. So those rules that she covered are specific to retirement accounts buying real estate. So now we're going to move on to 1031 exchanges, which are a completely different tax tool. Now the reason we cover both of these and why we're comparing them today is they're very complementary. So Kristen mentioned prohibited parties and you yourself not being able to do business with your IRA. You were on there as the IRA holder on that little family tree you saw of people your IRA cannot do business with. So what that means is if you own a property personally, you are not allowed to sell it to your IRA. Now, frequently when people bring up that scenario, I own an investment property, I've been renting it out, it cash flows beautifully, and I'd love to sell it to my IRA, that way I could keep it all tax sheltered. Can I do that? For the reasons Kristen went over about prohibited parties, you cannot. So at that point, we segue into 1031 exchanges and how they could benefit you. So again, if you have any questions during this seminar, just please type them into the chat box, and you should all see that as part of your log-on. And at the end of the webinar, we will talk about all the different questions you have and give you clarification. So a 1031 exchange, at its core, what it is it's an investor property. So if you own a rental property, a piece of vacant land you're holding for appreciation, a commercial property, a business use property, whatever it might be, if you own that investment property, and again, you cannot sell it to your IRA to tax shelter it, what many people will do is upon the time of sale, they will use a 1031 exchange. When you sell your investment property, you will actually park the sale proceeds with a qualified intermediary. And we'll go over what a qualified intermediary is. So spoiler alert, Midland is a qualified intermediary. That's why we're talking about these rules today. So when you're selling that property, you park the sale proceeds with an intermediary, and you locate a replacement property, and we release those funds for the purchase of the replacement property. Now, why would anybody go through the trouble of doing that? It's because you're deferring the tax bill that's usually due upon the time of sale. So for any investor who's ever sold an investment property, you know when you sell a property, you have things like capital gains tax, you have the depreciation or capture tax. If you're in a state that has state tax, you'll have that as well usually. And if you're in a certain income bracket and have certain investment income, you're also going to have the new 3.8% healthcare tax. Now again, like we said, if you want an exact calculation of what tax is due, you're going to have to talk to your CPA or tax advisor, because only they know how much gain you have, how much you've depreciated, if you're applicable to that 3.8% healthcare tax. But the good thing to know, and what you should come out of this webinar knowing, is that the 1031 exchange will defer all of those taxes. Now, how flexible is a 1031 exchange? So many people think, well, when I sell a property, I have to buy the exact same type of property. Now, that's not true. So, for example, if you're selling vacant land, you can exchange into property with greater income potential. So in this diagram, you're going to see residential or commercial. So just because you're selling vacant land, you do not need to exchange into another piece of vacant land. You're looking for investment to investment. All right, you can consolidate or diversify. So maybe you're selling multiple properties and want to take those sale proceeds and roll them into one much larger property. So that's the consolidate feature. You can also diversify. So in exchanges, if you wish to sell one large property, you can actually take those sale proceeds and roll the money into multiple smaller properties. So again, exchanges are very flexible as far as moving from property types and the number of properties. Some individuals, their goal in an exchange not only to defer the taxes, but is also to acquire less management intense property. So in this example, you'll see people selling commercial and residential property and exchanging it into vacant land. Obviously, their goal here is to exchange into a property that will require less time on their side to manage it. And then lastly, you'll see many individuals moving markets. So if you're selling your property in an area that might have been a very popular investor area years ago, but now you've noticed a up-and-coming market that you'd like to place that money into, a 1031 exchange will allow you to sell an old investment property and roll the sale proceeds into another, maybe better property that might give you a better return on your investment. All right, so to do a 1031 exchange, there's 5 basic rules that you need to know. All right, the first one is the net selling price. So what exactly do you have to spend in order to not pay any taxes during your exchange? And again, the goal is to defer the tax bill. So when you're selling a property, your gross sales price minus any closing costs. And closing costs are things like sales commissions, title costs, doc stamps. So that gives you your net selling price. When you have your net selling price, that is the magic number that you have to spend on your exchange to defer the entire tax bill. All right, the next thing you need to know is the property has to be what we call real property. So the properties must be held for investment or business use, meaning primary homes or secondary homes are not going to work in a 1031 exchange. That's a very frequent misconception. So when doing an exchange, keep in mind it has to be investment property. It could also be business use property if you were owning the property for use by your own business or something of that nature. And again, like kind applies to the character or nature of the property, not its quality or grade. So think back to our original example where you were selling vacant land and rolling the money into something like commercial property or residential property. You are allowed to change property types and grades. It's more of, is it investment property? Are you going from one investment property to another? All right, the intermediary. So again, in a 1031 exchange, you are selling a property, parking the proceeds with an intermediary, and then the intermediary is releasing the sale proceeds to purchase your new property. The money never touches your hands, and again, if you follow all these rules, you're deferring the tax bill. So the qualified intermediary has to be a third party. Now, it cannot be the taxpayer themselves, so that's the person doing the exchange. It cannot be an agent of the taxpayer, such as a realtor or attorney, and it cannot be a lineal descendant of the exchanger. Now, more importantly, here at Midland, we've been doing exchanges for over 18 years. We have individuals on staff who are certified to be doing exchanges. We call them CES, Certified Exchange Specialists. So what you're looking for in an intermediary is that they have experience, they have a track record, and they can walk you through those IRS regulations. All right, hardest part of a 1031 exchange is this slide, timelines. So when you sell your property on day one, you close on your sale and your clock starts ticking. You have two key deadlines to remember. The first one is day 45. So after you close on your sale on day one, the clock starts ticking. By day 45, you have to identify replacement properties. Now, what most people will do is you can identify 3 properties of any value. So identify does not mean you have to be under contract. It means you are formally identifying those 3 properties on a piece of paper that we give you to fill out. You provide it to us as your intermediary, and we file that. So once you've identified those 3 properties, you are locked in by day 45, meaning if on day 46 you find another property that you would like to use for the exchange, it is too late. You have to lock in your identification of your replacement properties by day 45. Now by day 180, you have to close on either one or all of those properties depending on what you want to do. So day 180 is when you must formally close on all intended purchases. So those 2 key deadlines, 45 days and 180 days, are what you have to keep in mind. Now, keep in mind, day 1 does not start until you actually close on your sale. So many people will say, well, what happens if I'm under contract? Will that start any timelines? No, it will not. What we're looking for here is the day you actually close on the sale and the day you actually close on the purchase. You can go under contract for either one at any time. All right, other important information. Whatever way title is held on the property you sell must be how title is taken in the new property. And that all boils down to the government looking at the tax ID. So if you were to sell a property and then change the entity you're using to purchase the new property, if it's not the same taxpayer, the government's going to have a hard time seeing that you've done the exchange. So keep in mind you have to keep your titling consistent. The same title of the seller has to be the same title as the buyer. The exchange must be in place prior to closing on the sale. I can't tell you how many people have called me in the past and said, I just closed on my sale. I have the check in my hand of all the sale proceeds. I'm ready to start my exchange. Well, unfortunately, at that point, you are too late. You have to have the exchange set up prior to closing on your sale. Now, the reason is this. The title company will actually update your closing documents to reflect you're doing a 1031 exchange, and it will list us as the intermediary. What that means is when you close on your sale, that title company will send your sale proceeds directly to your intermediary, directly to us. The money will not touch your hands. So please, please make sure that you have your exchange set up prior to closing. Holding periods. Many people will say, well, how long do I have to own the property before it's eligible for a 1031 exchange? Now, unfortunately, with the government, there's no black and white answer on that. Many people will talk to their CPAs in regards to how long they should be holding properties. Rule of thumb that some CPAs will tell you is either a year and a day to 2 years. So a year and a day because it's spanning 2 tax periods, or 2 years because that's the government's safe harbor rule where they will not question it if you've owned that property for investment use over the last 2 years. So again, we're not giving you any tax advice. Talk to your CPA if you have a particular situation, but those are the general rules of thumb. The last point on that last slide was essentially no fixer flips. So if you are a dealer, if you are in the business of buying, rehabbing, and selling, you are probably not going to qualify for a 1031 exchange. What that means is essentially in relation to the holding period. So if you're running a business, you're not holding it for investment passive use. You're essentially trying to conduct a business and avoid the taxes. So just keep in mind, No fix and flips, and dealers who are buying and rehabbing will probably not qualify. Now, if you were to buy, rehab, and then hold that property for rental use over a year or so, then maybe you would qualify. So that's a strategy some investors will use. All right, now we're going to go over the differences, just comparing real estate in an IRA versus 1031 exchange, just to hammer home the point that these are two completely separate tax tools.
Okay, so deadlines and holding periods. Like Kelsey had just gone over in terms of the 1031 deadlines and holding period, the holding period is not defined by the IRS. Midland, when we handle 1031 exchanges from a conservative standpoint, do adhere to the 2-year rule as the holding period. She also went over the deadlines in terms of how long you have from closing on the property to purchasing the new property for the exchange. So those windows are very finite, and the IRS, if you fall outside those deadlines, will not allow the tax deferred status to happen. With real estate IRAs, there are no holdings or there are no deadlines or holding periods, meaning you don't have to close on a property within a certain amount of days. It depends on the contract itself and the buyer and seller. As well as the holding period, there is no defined holding period by the IRA or IRS for how long that property needs to be held in the IRA.
All right, as far as reinvestment of sale proceeds, in 1031 exchanges, as we talked about, when you sell your old property, you must reinvest at least that net selling price, which was the sales price minus any closing costs, to defer all the taxes. Now, in a real estate IRA, that does not apply. So the real estate IRA is more flexible in this regard as well. So if you were to sell a property that your retirement account owned, the sale proceeds would return to your retirement account, and you would have no obligation to reinvest them. It's going to be tax sheltered regardless of if that cash sat there for years, or if you sent it to a different IRA to do stocks or bonds, or if you bought another property. So again, reinvestment of sale proceeds, you must reinvest your proceeds in a 1031 exchange, and you have to spend at least that net selling price. Whereas in an IRA, it's already tax sheltered since it is a retirement account, and upon the sale of a property, the cash returns to your IRA completely tax sheltered, regardless of what you do with the cash once it arrives.
So when it comes to the personal use of the property, these rules are a little bit different. So with a 1031 exchange with the property, you can use the property 10% of the days rented, or up to 2 weeks, assuming that the property has been rented for those 2 weeks, and you're able to use the property for whichever of the two is greater. Whereas with real estate held directly in an IRA, you are not able to use the property in any way for personal use until that property is moved from the IRA. So that means that you're not even technically supposed to step foot on that property while the title is held in your IRA.
All right, let's talk about the owner of the property itself. So frequently when we're talking about these two different tax rules, we'll keep them separate in investors' minds by saying they're two different bags of money. So one bag of money is your personal funds. So with 1031 exchanges, those are for properties that you already own personally, or maybe in your entity or your LLC. You purchase the property through your own personal savings or obtaining financing. It is property that is, outside of a tax shelter. Whereas real estate IRAs, it's a completely separate bag of money. So real estate IRAs, the source of those funds are your retirement accounts. So if you were to have, let's say, a 401k, an IRA, a pension, any type of retirement account, you can use those funds to buy real estate. Now, again, it has to be a brand new property purchase. If you already own the property, it's too late to put it in your IRA. So with real estate IRAs, these are brand new investment properties purchased directly in your IRA using your retirement funds. All right. So I think, oh, go ahead, Brenda.
Yes, so we are going to get to the questions now. We have quite a few, so I'm still going to be taking more questions as we're answering these ones. So if you have any other ones, just type them in the chat box. All right. For the first one, Kristen, can a rental house become an IRA without paying capital gains tax? Kristen, are you there?
Yes. Can you repeat the question? I'm sorry.
Can a rental house become an IRA without paying capital gains tax?
So if I understand that question correctly, if the rental house is held outside of the IRA currently, you're not able to sell it to your IRA and move that property in there to get that tax deferred status. So that avoiding paying taxes on the capital gains only applies to a property that's purchased by the IRA and held in the IRA. You are able to rent out a property that's held in the IRA, and yes, that rental income would be tax deferred.
All right, wonderful. Another one for you, Kristen. Can you discuss further the fact that I am the owner of the IRA and I'm also a disqualified party?
So when you're the owner of the IRA, it's different than you individually holding a property. So the IRA has a different tax ID number, and that would be the tax ID associated with holding the property. Whereas you yourself, the property owner, would be associated with your Social Security number. So while you're the owner of the IRA, those funds are retirement funds. They're not your personal funds. So that's the main difference. You individually would use your personal funds versus with it being held in the IRA, those are the retirement funds.
All right, and one more for you, Kristen. If I roll over from another IRA, can I contribute more in a fiscal year than the $53,000 or whatever the annual limit is? I also chatted you this.
So if you're rolling over from another IRA, that does not count towards your contribution limits. If it's from another IRA, you would still, that would be considered a rollover, but you can still contribute up to the limits for that year depending on what they are for your specific IRA type. In addition to that, with the specific IRA type having contribution limits, you're also, your age would play into those as well.
Okay, Kelsey, regarding 1031 exchanges, is a mortgage payoff included in what gets subtracted for the net sales price?
That's a very good question. The answer is no. So the mortgage payoff is not included. So that net sales price that we talked about, the magical number that you had to spend in a 1031 exchange to not pay any taxes, it is the sales price of your property minus closing costs, things like realtor commissions, doc stamps, etc. The mortgage is not included. Now, a lot of people will say, well, that's not very fair because I'm not getting, cash from the closing, including the mortgage. So if I've got a substantial mortgage and I don't get that cash, how can I reinvest it in another property? The answer is essentially, the 1031 cannot be used for debt forgiveness. So if you have a mortgage in the old property you're selling, you can either take out a mortgage of equal value in the new property you're buying, or if you have personal savings in cash, you could bring additional cash to your purchase of the new property and make up that amount of the mortgage in cash. So again, the amount you have to spend is contract price of what you're selling the property for minus closing costs, does not include any mortgages.
All right, Kelsey, for the 1031 exchange, can you sell the property, Midland holds the proceeds, and later the investor is able to buy a different property? In other words, can there be a lapse set of time between the sale and the new purchase?
So if I understand the question correctly, that is the entire intention of the 1031 exchange. So in a 1031 exchange, you are selling the property. Midland IRA is acting as your qualified intermediary and actually parks those sale proceeds for you. So we hold the cash in an escrow account for you. The money does not touch your hands. Later, you have to go out and locate a new replacement property to buy. And once you locate that new replacement property, we release the money we're holding for you to fund the purchase of that new property. Now, again, keep in mind, those timelines still apply. So you have 45 days to identify from the date of your sale and 180 days total to close on the new purchase. So yes, that is the entire intention.
All right, Kristen, on the self-directed IRA side, how does the owner exit out if they no longer wish to continue?
Okay. If I understand that correctly, you would be referring to closing an account. So if you have the property in your IRA and you no longer wish to have that IRA and you want to either sell the property, and then you can have those funds come back to your IRA account and we would send those to you as a distribution. Or you also have the option to remove the property from the IRA with the title itself as a distribution. So there would be certain stipulations that would need to be met in order to do that, but you do not always have to sell the property in order to remove it from your account. A lot of people do at a later date decide that they want to live in that property once they retire. So they distribute the property from the account and pay the taxes on the value of that property depending on their IRA type.
All right, wonderful. Kelsey, can I 1031 from 3 residential rentals to a direct placement real estate partnership like a senior housing development?
So if you're going from real property to real property, absolutely. So you're selling 3 residential properties and you're rolling the sale proceeds into a partnership where you will own a portion of that senior housing development. Absolutely. Again, the key is that you're going from a real property ownership to another real property ownership.
All right. Kristen, is there a way to sell your primary residence to an IRA and then rent the property as an investment? I do understand I cannot rent the property while held in the IRA.
So unfortunately, in that specific scenario, you're not able to do that. Because you yourself are disqualified from the IRA, you're not able to sell your primary residence to your IRA and then hold that property as a rental property.
All right. Kelsey, can you sell a vacation home that is not an investment property through a 1031 as long as you replace with a true investment property?
Well, vacation homes sometimes qualify for 1031 treatment. So again, like Kristen had discussed, there's that rule about personal use, the 2 weeks or 10% of the time rented. So if your use is minimal enough of that vacation home, it should qualify for a 1031 exchange. And when you sell that vacation home, you can roll the sale proceeds into another investment property. If your personal use of that vacation home exceeds those thresholds, then unfortunately it most likely would not qualify for a 1031 exchange. So if you do have a specific example, email us and we can send you the IRS verbiage regarding vacation homes, and you can consult with your CPA to make sure it would work for you.
Okay, to follow up with that question, can you sell your primary home through a 1031 and then replace with a true investment property that will not be used at all personally?
So primary homes and secondary homes are not considered investment use. So primary homes and secondary homes will not work for a 1031 exchange, even if your intention is to sell your primary home and roll the money into a true investment property. So again, keep in mind, 1031s are made for investment or business use property. Primary homes will not qualify, secondary homes will not qualify, and vacation homes will sometimes qualify based on your use of the property.
Okay. Someone asked if they could get a copy of the slides. I will be emailing everybody the copy of the slides as well as the recorded webinar afterwards. All right, next question, Kelsey. I have a condo in San Francisco worth $800,000. It was an investment property from 2008 to 2013. Can I sell the condo in San Francisco for $800,000 and buy property for $400,000 in Florida using a 1031 exchange?
Well, the only thing that would lead me to ask you further questions, as you mentioned, it was an investment property up to 2013. Since it's now 2016, that makes me wonder what the property's been doing for the last 3 years. So for the last 3 years, if it has not been investment use, that's going to be an issue. Let's say you rented it out all the way till now. You're selling it for $800,000 and you want to roll the sale proceeds into another investment property that's $400,000. Again, if it's investment use, that would be perfectly fine because you've rented it out for quite a few years. The only issue I would see at that point is that you're going down significantly in value. You're selling for 800, you're buying for 400,000. And like we talked about, you have to spend that net selling price to defer your entire tax bill. So just be aware at that point you might have some taxes that are due because you're not spending enough in your exchange. You can do also at that point what we had demonstrated with those graphics, where you can sell a large property and actually diversify into multiple smaller properties if you wish. So at the end of the day, you'll want to consult with your CPA and figure out what your tax bill would be if you sell for 800 and roll into 400. And again, you'll want to make sure that you're renting it out prior to doing your 1031 exchange. If you've been using the property as your primary residence for the last few years since 2013, primary residences do not work for 1031 exchanges.
All right, thank you. All right, I can get this question. Does Midland offer any kind of information, brochures, website links, etc., where a real estate agent could provide information to their clients? Well, we definitely do. If you go to the Investments tab on our website and click on the Real Estate Center, we have a Real Estate Professionals page on there. And you can customize brochures with your contact information, as well as a cheat sheet about real estate IRAs and 1031 exchanges. Or if you email me, I can mail you nice brochures that we have on both topics. All right. Next question. It looks like the application includes the process of getting a new Social Security number. I guess I don't understand that question. You just have to include your current Social Security number. The same person says, I'm 43 years old, roll over from another IRA. How soon can you purchase a new property? Kristen.
So you can purchase a new property as soon as the funds are available and we have all of the required documents. So you would have to make sure that you have a properly titled contract listing the IRA as the purchaser, as well as the documents that we would require at a closing, which would be the settlement statement, a deed, title commitment, and depending on the type of property, hazard insurance. So as soon as you're able to get all of those documents ready, we can close within the next business day.
All right, thank you. Just so you all know, we only have a few more questions left, so if you have any other questions, send them in now so we can answer it before the end of the presentation. Another one for you, Kristen. How does the partnership work if you both use IRA funds logistically? What do both partners need to do?
So if you're both using IRA funds, it would be the same process. I'm not sure if both accounts would be held at Midland, but you would just be tenants in common on that purchase. So what we would need to know ultimately on the front end is what the percentage split would be between both parties, because that would then become part of the vesting that would be listed as the purchaser for that property.
All right, thank you. All right, this one's for either Kristen or Kelsey. If you own a majority share in a corporation and the corp owns property, is the corp considered a prohibited party?
So a prohibited or a disqualified party in terms of entities would be any entity of which you or another disqualified party own 50% or more of that entity. So if you and a disqualified party are less than 50% owners, then it would not be disqualified.
All right. Kristen, regarding an IRA, can the expense be paid to me as a property manager?
So because you are disqualified from the IRA, you cannot be the property manager that would be paid for doing those duties. All of these properties need to be solely for investment purposes, which means that you can't have any personal benefit while holding this in the IRA. So being compensated for being a property manager would be considered a prohibited transaction.
All right, and we're down to our very last question. Kelsey, if I wanted to sell my personal home, how long does my personal home have to be an investment to do a 1031 exchange? Kelsey? All right.
So the rule of Oh,
Go
can you
ahead,
hear me,
sorry.
Brenda? The rule
Yes.
of thumb is generally 2 years. So you convert your primary home into an investment property, you rent it out for 2 years, and essentially at that point it is then eligible for a 1031 exchange. You've fulfilled that safe harbor rule of 2 years, and at that point you can sell it and roll the proceeds into another investment property.
All right, perfect. Okay, that seems to be all of our questions for today's presentation. If anyone does have any other questions they didn't get answered, please email it to us. I'm going to be emailing you all the recorded webinar as well as the PDF and a few flyers to hand out if you'd like. Thank you, Kristen, and thank you, Kelsey. You guys did a great job. I hope you all have a great day.